Good afternoon, everybody. My name is Todd Jones. I'm the Director of Investments for Gratus Capital. Today is August 11th, 2020, and I wanted to thank you for joining us on our next edition of Market Matters. Briefly, let me go over a quick agenda here. We're going to touch on our updated cadence with Market Matters. We'll also be touching on, as we typically do, COVID-19 updates, some economic and investment updates, and then also a review, or a little bit more thorough review of Q2 earnings and maybe how that might be layering itself into our thought process. As with most Market Matters, we are on Zoom, so please, if you do have any questions, please throw those into the chat feature of Zoom. I'll try to grab those as they come in and incorporate that into the content today. And because we don't have a guest speaker, it'll be probably a more typical duration of this program, roughly about 30 minutes, maybe a little bit less, depending on how long and how many questions that we have. So let me just get to this first bullet point here, which is new frequency. So this will be our last bi-weekly Market Matters. In the future, we'll be doing Market Matters every month on a monthly basis instead of on a bi-weekly basis. And I think that just makes sense. You know, markets have recovered, less volatility in the markets, and I think this is a more repeatable pattern that we'd like to sink into to give you all more, opportunities to think about questions and things of that nature. But the good news is that by moving to a monthly format, we are going to be bringing you, sometime here in the near future, a new piece of content, which we hope you enjoy. Maybe this Monday, might be the Monday following, but we're calling it 2 Minutes with Todd. And essentially every Monday morning, we're going to give you a 2-minute snapshot of what happened last week and we're looking at for the week ahead. And if there's any, special areas of consideration that we're looking at, or portfolio ideas that we're looking at, to keep you up to date on what we're doing. So those will be available typically wherever you get podcasts. I believe they're also going to be available on our website as well too. So there'll be more information to follow about that offering. And here's just the logo to look for here down at the bottom that will give you an idea of where to go look. So with that, let's kick it off. So the all-important COVID-19 updates, and I think this is a bit of a good news, maybe not so good news story, but more good news than not. Globally, it does appear that the case count for COVID-19 cases is starting to level out. I mean, you can see here, based on some of the more recent data, while the upward trajectory does appear to still be intact to some degree, more recently over a shorter time frame, this case count does appear to be leveling out. I think that's really important to give everybody comfort that, we're going to see eventually an end to this, or at least some containment. Additionally, I did want to point out, and this is again a great website or great data series through Bloomberg, if you can find it within their website. But there are some areas that you may be reading about recently that have started to see some reinfections that actually is consistent here in the U.S. as well too, with the return of school in a lot of areas. But I guess disturbingly, the United Kingdom, which had a really good downward progression with their case counts, has now started to reaccelerate, as well as Germany, which is unfortunate because Germany had been really a leader in COVID containment. Now does appear it's starting to rise in case count again. Maybe that has to do with better testing, because they are, I know, doing a lot more tests than they used to. But nonetheless, we still have to keep an eye on that. And then, of course, watching dynamics in India right now, because India case counts continue to be rising at a bit of a parabolic rate. Maybe some leveling off, we'll have to see. But, that's just something that we're keeping an eye on, because obviously it's a very populous country, can have a big impact in the region, which is Southeast Asia, or I guess South Asia. And, just something that we want to make sure we're keeping an eye on. The good news I alluded to, though, is that based on this data set from the New York Times, this is their COVID tracker that's tracking every vaccine or treatment for the coronavirus. based on some of the information that they updated as of August 9th, which is 2 days ago, you can see now there's been a little bit of pipeline movement. You may recall last Market Matters, there were 6 drugs in phase 3 trials. Now there's 7, which is great. There is one for limited use, but I think that's only for very specific circumstances, which would not have wide application within the general population. There's been a few drugs that have fallen out of the preclinicals as some of those test results have come back. A few that have fallen out of phase 1. Phase 2 is the same, but the big one, which I think the market is trading on as an incremental positive, is that there are 7 drugs in phase 3 right now. And if you believe kind of what's going on behind some of the scenes at the FDA or some of the sciences, President Trump has indicated that there should be at least one vaccine available by November 3rd, which coincidentally is roughly around the election time. But we'll actually see. I mean, there's a lot to be discovered and a lot of tests to be done on that front. But the fact that we have 7 drugs in phase 3 trial means that our shots on goal here for a cure or a vaccine are higher than they were maybe 2 or 3 months ago, which is really, really good news. And again, no one could have predicted how fast the science would advance within this regard, but the market seems to be able to discount some of these things better than a lot of folks can. So let's turn to the economic and investment updates here briefly. I've just removed from the investment ratings scale our previous ratings. Those were around developed markets internationally, and emerging markets. We had upgraded those as our most recent upgrade. There haven't been any upgrades or changes within the last few weeks. So we're, there's no reason to keep those previous views on there. But, still, I think the rankings remain the same. Debt, generally speaking, or bonds, generally speaking, will likely undergo a re-rating here at some point once rates get down to a certain level. We haven't decided exactly what that level will be exactly, but we'll just know that we're keeping an eye on that, and we'll have some portfolio adjustments likely if rates get too much lower. So turning to some of the summary comments here before we get into the meat of the presentation. There's a lot of text on here, so I don't want to necessarily read all these. Some of these is holdover from last Market Matters. But I do just want to reiterate, we are still taking a fairly cautious stance as the rally continues to go higher, especially on the equity markets. And by that, what we mean is we are starting to build our cash positions a little bit higher in these ultra short-term bond ETFs. Again, you're earning anywhere between 1% to 2% there, so we think that's an adequate risk reward right now for that part of the portfolio. But most importantly, we want to be able to act when the markets get volatile again, which by all accounts they likely will into the election season. We also want to make sure that we're thinking about, what might be a catalyst for the market to turn lower. And one of the overarching consensuses amongst our team is that when an actual vaccine is discovered or announced. Now, you may have noticed that today, Russia has indicated that they have got a vaccine that they'll be, rolling out to their population within the forthcoming months. That's providing some, that's providing some uplift to the market, which clearly that's trading off of that right now. But I think it's not necessarily a dependable announcement, and that's partly the reason for the muted reaction. I think if a U.S. company or the FDA or President Trump announced that there was a vaccine announced, you would likely see a big spike up in the equity markets, and that I think would be the time when we would see kind of a peaking out of price potential in the equity markets, and we would look to get much more conservative. On the equity side, you can see just some notes here. We'll touch on them a bit in more detail, but earnings season, now we've gotten most of the numbers in for Q2, has by and large been a really spectacular success based on relative to the expectation going into Q2, and that's a key point of distinction. We did do some rebalancing last week, and this speaks to the becoming a little bit of conservative or just risk management. within our strategies that have dedicated growth strategies within them, our benchmark and our dividend hybrid strategies. We did do some trimming of those positions because those have done far better than the value, quote unquote, value-oriented strategies. And we just think that's a prudent course of action to trim back within some of those strategies, the parts of the portfolio that might be a little overextended on the growth side. So we think that was the right answer. And I think that it does appear to be well timed because the last 3 days, value has substantially outperformed quote unquote growth to the order of about 5 or 6 percentage points. So maybe it's better to be lucky than good sometimes, but I think the process around which we are rebalancing has helped us arrive at those conclusions, which appear to be right so far. On the fixed income side, just a point to note here, we do anticipate more action out of the Federal Reserve at some point when markets get a little sideways. Part of that's yield curve control. But more importantly, I think it's likely that based on what we're seeing, even with the improvement in the economy, rates have been stubbornly anchored down at this, 55 to 60 basis point range. And, if our contention still remains that yields will likely go lower, given the demand destruction that likely occurred with COVID-19 and some of the demographic issues, which we'll touch on. And then finally, just a point about, what do we do or what are we going to do if fixed income rates go lower? Well, we'll be looking to our alternative strategies to comprise more of the income component of the portfolio going forward. Haven't decided exactly how that's going to look because we're not quite there yet, but it's certainly on the mind of our investment committee and something that we'll be looking forward to updating you on more in the future. So let's take a look at the recovery so far. And this has been the experience through April. This is a GDP, gross domestic product. Actually, I think it's through, it's through April. And this is a projection from Goldman Sachs, which I think is actually pretty emblematic of what the general thinking is on Wall Street right now and some of the estimates that we get from some of the economic data providers that we have. So when is the economy going to return to full potential, I guess is the real question. With the current rapid rate of development with the vaccine, all data points would suggest that sometime within the neighborhood of between April and July of next year is when we'll see the economy at a level that it was in February of this year. So a very sharp downturn followed by a pretty sharp recovery driven by, vaccine and reconfiguration of the economy, particularly within the tech sector. But, if that doesn't happen, there are a few alternate scenarios that Goldman Sachs lays out here, which I think are probably fine to contemplate, and what this shows you is if we get a vaccine sometime in Q2 of 2021, well, then we shouldn't expect a full recovery in the economy until probably Q3 of that year. Same if we find a vaccine in Q3 of next year, then that pushes the recovery date out to Q4 and so on and so forth. So anyway, this is an interesting look because it's a far quicker recovery than I think most had expected, but it just shows you there's some resilience within the economy. There's some pent-up demand, and ultimately that will be good for equity prices and risk assets if that in fact does happen. And let's take a look at the actual recovery and some of the numbers that we've been seeing. So this is the employment picture. This is the non-farm payrolls. It's a number that comes out, I believe it's every Friday. And the point I wanted to make here is that while yes, that this speaks to the actual numbers of employed, and there is quite a bit of, capacity that was lost when going in right prior to the crisis. But the point I want to make here is that some of those jobs have been coming back very rapidly in certain parts of the economy. Certainly retail, entertainment sectors have been, just devastated. Those aren't likely to come back anytime soon, nearly to the degree that they had been, pre-COVID. But certainly on the services side, even some manufacturing jobs, those are starting to come back pretty rapidly as demand starts to recover. Looking at the actual manufacturing sector itself, this is on the screen. What you're seeing is a index going back to 2005. It's called the ISM Institute for Supply Management Manufacturing Index. And this is a survey that they give to all folks within their manufacturing network, of which there are thousands in the US. And they ask them a number of questions. Basically, it's a sentiment survey that's been very predictive of the way the economy will likely go. And what you see here is while Purchasing Manager Index survey started to get, less positive, and just for reference, anything over 50 indicates that there is expansion or likely expansion to occur based on the survey. Anything under 50 means there's a contraction likely to occur within the manufacturing sector. And you can see how that played out back in 2008-9 timeframe. And what you're seeing here, though, is that there has been a much more rapid recovery within the manufacturing sentiment and Purchasing Manager survey than even the expectation. So the survey results were for 53.5, and that came in at 54.2. And so beating on the expectations on the survey side within the manufacturing sector, that definitely is positive and gives us, confidence that maybe some of this will be a sustainable recovery. But you combine that with the services sector. This is actually, sorry, mislabeled. That's ISM Services PMI. Sorry about that. But what you can see here, very similar orientation going back to 2005. Anything above 50 is expansion. Anything below 50 is contraction within the services sector. And what you can see is here on the services side in particular, and this I think would anecdotally be very similar or consistent with what we all probably notice within our jobs that we have, at least in my peer network and others. And that is, survey was for 55 last week. We actually got a 58.1. So a much better or bigger recovery in sentiment on the services sector side than had been expected. And again, I think this really speaks to, the underlying resilience of the services economy, and is one reason why I think the market is trading a little bit ahead of where the actual fundamentals of the economy are right now. And I did mention in the invitation today, we wanted to talk a little bit more about the earnings picture for Q2, because I do think, this is the first full quarter in Q2, all the impact of COVID-19. Recall that COVID-19 really actually started to impact the US in the last part of February on into March. It really was a partial quarter impact. This is the first full picture, and we've gotten roughly, I think 95% of all companies have reported earnings so far for Q2. And there's a few things I wanted to note here. This is by sector. So you can see the S&P here in the middle and every sector of the S&P. You can see what the expectation was for growth in earnings on June 30th at the end of Q2 in the gray bar, and the actual expectation or the actual results that came in the blue bar. And what you might notice is for almost every sector, those reports for earnings came in much better than expected, particularly in the utility sector, but that's not really important for us because we do own utilities in the dividend strategy, but just from a part of the S&P, it's not a very large contributor. But what is more important to us is the contribution from healthcare and information technology, which, as you can see, actually posted positive earnings in Q2 on a year-over-year basis than what the expectation was. I mean, look at the healthcare difference. -14 was the expectation coming into Q2, and they actually came out with +7, and that's a massive difference in earnings. And I think it also speaks to, for those of you that were able to join us for our dividend strategy call update last week, this also helps maybe frame out why we're overexposed or have an overallocation right now in our dividend strategy to the healthcare and IT sectors. It's one thing to actually say you're doing something, but another thing, as we showed you last week, to be allocated to those sectors. And these are reasons why we like both of these sectors right now in a larger weighting than we might normally have. It's because they have a very durable earnings stream, despite a pandemic that's the first in 100 years. But maybe notwithstanding IT or healthcare, every other sector, by and large, reported better than expected earnings, with the exception of energy. And energy is really a difficult nut to crack sometimes because every energy producer is different, and it's all dependent on regions and things of that nature. But As you may know, we have very little exposure to the energy sector right now anyway. And so it just really wasn't a big issue for us. So looking at that contribution, this is what I was talking about earlier about, it's about beating the expectation, not necessarily posting the best numbers, because because remember, the stock market is a forward-looking indicator or market mechanism, not backward-looking. And therefore, if you're beating future expectations, then that has a way of driving stock prices up. So this is a by sector view, same sectors to include the S&P right here in the middle. The green bar means that companies, and they all sum to 100. The green bar means that companies within the sector by this percentage point amount beat estimates. The yellow bar means they came in line with estimates, and red bar means they were below estimates. You can see how that kind of matriculated through here all the way down to real estate and energy. And as you might imagine, real estate, only 30%, only 60% beat estimates. But, that's kind of a mixed bag, given that you've got, not only malls and hotels and strip malls in there, but also office buildings, data centers, and the like. But again, going back to percentage of companies that are beating, you want to kind of be in those sectors where most companies are beating their earnings expectations. And you can see that coming through very nicely within the information technology sector, materials and industrials as well, but also in healthcare. And those are, key industries for us that we think have really durable potential. And what this means is roughly 88% of companies in the S&P beat earnings estimates. But more importantly, the magnitude of that beat was massive. It was a 22% beat. So that helps, I think, everyone conceptualize why the market is where it is, because the earnings that are being reported right now are coming in just a lot better than expected, number one, on average, but also by a magnitude that's not been seen since 2008 and 9. And then, of course, going back to the sentiment ideas, as you all may remember or know, I'm a big fan of looking at sentiment, because that has a way of telling you if the market is, topping out or under. Bullish sentiment index, which has been tracked, I guess, back to the 90s, I believe. And it shows, what the chart here shows you is the S&P in the red line. And in the blue line, this is the number of people that are identifying themselves as quote unquote bullish or positive on the market. And what you might notice is right as COVID hit, not too dissimilar, by the way, to the financial crisis, which you can barely see here on the far left. But, obviously individual investor sentiment collapsed down to this really low level, which we're actually nearing right now. But more recently, individual investor sentiment, has collapsed down to these very low levels, which, and the way I read that and interpret it means that there's still some room to the upside for the S&P to go. Because if everyone is identifying as, not bullish or very cautious, that means there's still some more incremental upside that can be had within the market without a lot changing, just because there are more people getting involved. So that's good for the market, and one reason why I think we can kind of stay at these levels, maybe up and through the election timeframe. And then just taking a look at the equity picture here real briefly in our last few minutes. Similar dynamics, nothing really out of character from my previous comments. Obviously, just by way of reference, year-to-date picture of the equity markets. The red line is the S&P. The pink line is the emerging markets index. The green line is the developed international markets index, and the blue line is the small cap index. And again, part of our approach has been take risk where it's been warranted. As you may know, we have kept most of our exposures on the equity side to the red line, to the S&P type companies, but we have started adding to the green line because, as I mentioned in the last few weeks, the dollar continues to decline in value versus other major currencies or trading partners. And that's going to be a nice tailwind for international stocks, which it already has been for emerging markets here into the future. And particularly because, currency cycles tend to be longer lasting. We think that the dollar can probably decline, from here over time for the foreseeable, 1, 2, maybe 3 years. Fixed income continues to be the same story. The Federal Reserve has done a great job of taking a lot of the risk out of fixed income markets after the COVID situation hit. You can see that playing out in spades here in the most risky parts of the market, where what was once unthinkable back in March, the junk bond market, how could they possibly get back to break even? Being down 22%, well, guess what? It happened last week. We've been avoiding junk bonds the whole time, so we never suffered the drawdown, but still one of those areas of the market we think is way overvalued, still has a lot of risk attached to it, and it's not worth chasing, as they say, not worth chasing nickels in front of a steamroller, because you're going to get run over one of these days in some of these riskier parts of the fixed income market. What's also kind of fascinating is that the investment grade market is really rallying on Fed intentions to buy investment grade bonds directly in the market. And so we think that the investment grade market is probably overshot a little bit on the upside as well too. So we're pretty cautious on that front. Keeping some ultra short, bonds in there is probably a good idea. But I did want to just kind of reiterate, I mentioned this in our market update that we did in person. Seems like ages ago when we were all in person, but at our last market update in, I think it was February, I said, 10-year bonds still to me look like they have a destiny with zero, or a date with zero. And I think that's been the case by and large, unfortunately this year, because it's a demographic thing, not necessarily a economic driven thing. But you can see, I think part of the reason for that thought process is because, the German bond, very comparable economy to ours, is now trading at negative 52 basis points in their 10-year. And I think, the U.S. shouldn't be that far behind over time, given some of the demographic issues, some of the rapid advancements in technology that are replacing pull forward that's likely to occur with some of the technology and work from home dynamics that are going on right now. So this is a key dynamic within our thought process, and we'll be watching bond yields very closely, because they are the reference rate around which all financial instruments derive a value off of. So you can see here too, the U.S. 10-year bond and the German 10-year bond used to trade actually almost identically until the European financial crisis hit in 2012-13. And so now that we've had our own kind of financial crisis here in the U.S. with COVID, I just don't see this staying at these levels for a whole lot longer. I could be wrong, of course, and we'll change our thoughts if the data changes. But I think this trend is still, pretty firmly in place. But the good news is as rates go lower on the consumer side, mortgage rates now are hitting their all-time low level since data started being collected on mortgage rates back in 1971, I believe it was. So now the average rate on a 30-year fixed mortgage for a conventional mortgage, I believe, is somewhere in the neighborhood of 2.75, 2.85, something like that. And certainly lower for certain other types of mortgages like VA loans or other types of instruments. But that's good news for the consumer, and that's also putting a bid under the single-family home market. Not necessarily commercial real estate per se, but single-family home market continues to register gains in most regions, with the exception of like New York condos or Miami condos, things of that nature. But single-family homes are certainly seeing an uptick in volumes, which is really good, for those markets as well. Because, obviously there's a lot of the economy that is attached to the single-family home market. So here's just a few takeaways before I move to any questions. Looks like there are some questions, which is great. So here's just a couple of takeaways. One is we still remain cautious. I mean, we're not overly cautious. By that I mean we're still maintaining our equity targets or our equity positions at levels that are their targets. We're not necessarily letting them get too far away from those targets, but we're by no means scaling back our equity exposure, because I just don't think that the conditions are right to have to do that quite yet. We are doing some smaller adjustments, though, that are important to helping contain the risk in the portfolio. As I mentioned earlier, we sold back our growth exposure a little bit for the strategies that have growth funds and added to more value-oriented strategies, which is, I think, really working right now. Dollar weakness continues to underpin many asset categories, which we are getting more positive on. Q2 earnings season was much better than expected. That's helped the market get to where it is. Q3, however, will be a much higher hurdle to jump over, and we'll start seeing some of those numbers come in the middle to late October, and that should be really interesting to watch all that unfold. And then finally, for now, we're expecting lower yields. By some measures, the 10-year should be somewhere in the neighborhood of 25 basis points by the end of the year. So don't be surprised if equity markets continue to go higher, rates go lower, and a lot of volatility in between. I look forward to speaking with you on next Market Matters, which will be September 1st. And we'll review what happened in August in a more fuller way. And then be on the lookout for the 2 Minutes with Todd episode that should be out within the next week or two. And barring that, have a great rest of your afternoon.